So I love chapter 9 because it's all about long-term debt and bonds payable. And the reason why I like this chapter is because when I worked in public accounting, I was the expert at my level in bond indentures. So I did a lot with bonds. All of my casino clients had bonds and significant bond debt because that's how they finance their casino expansions, their construction, their initial construction, and anything that they were doing. So we're going to get into it. I will be using the Excel so that you can kind of learn how to use it and calculate that issue price because you're going to need to know how to do it for the test. But we're going to start here. So bonds are issued through an underwriter, and then an underwriter is a bank. Basically, the company going out for the bond indenture is going to use this bank to actually issue the debt for them. I'll get to that in a second, Sammy. For bonds, when we're talking about bonds payable, we're looking at it from the issuing company. So they're issuing bonds to do some sort of project usually. So they're looking for funding. They're getting this funding through bonds. So cash flow is coming in when we go out for a bond indenture and we're borrowing a certain amount. And that amount is going to be considered a long-term debt of the issuing company. So the principal, the amount of the bonds that we're going to actually have to pay back in the future is what we're going to record in our bonds payable account. And it's considered a long-term debt, so meaning that we're going to be paying this amount in greater than 1 year from the balance sheet date. For our bond prices, so bonds are listed and the face value of those bonds is going to be different than the issue price. The issue price is how much we're actually going to receive in cash from the companies that are purchasing our bonds. So the issue price is determined based on present value of the future principal and interest payments. And GAAP uses the effective interest method, which means that we're taking into account the stated rate or the interest rate these bonds are paying, as well as the market rate, what bonds that are similar to these bonds were paying at that date of issuance. And when we're looking at the issue price, it's usually going to be presented as a percentage of par value. So when bonds are being sold on the open market, you're going to see the bond issue price as a percentage of par value. It'll say that these bonds are being issued at 95 or 102. And what they mean is 95% of par value or 102% of par value. Face value is par value. On the bond certificate, you're going to see the issuing company's name. So the company issuing the debt, their name is going to be on the bond certificate. Principal, which is also referred to as face value, maturity value, or par value. So bonds are going to be issued in $1,000 increments. So if I need $500, I can't buy bonds at $500. I have to buy in increments with a face value of $1,000. So it's going to be pretty round numbers for that face value. $1 million in bonds, $1.5 million in bonds, $1 trillion in bonds are being issued. Principal is the amount that we record in our bonds payable account. So similar to notes payable, where we only record the principal amount in the notes payable account, bonds payable is the same. Only the principal is going to be recorded in bonds payable. The principal is the amount borrowed, but it's also the amount we have to pay back at maturity. Also listed on the bonds is the maturity date. So when these bonds become due, they're serial bonds. They may have different maturity dates. So a certain number or dollar amount will come due at one date. Another dollar amount of these bonds will mature at a later date, and so on. But in the examples we're going to look through, it's just going to have the same maturity date for all the bonds issued. One thing I forgot to note is that bonds payable is basically a large number of notes payable issued all at once. So instead of going to 10 different banks to get different notes at different periods of time, we're going to go through one bond indenture and issue all of the bonds at once, all of the notes at once. For the stated interest rate, that's also going to be listed on that bond certificate. The stated interest rate is how much interest these bonds will be paying each year. So the percentage of interest these bonds pay each year. So it's always an annual amount, annual percentage rate that's given to you and offered. That stated interest rate is established when we determine that we want to go out for a bond indenture. So we're going to look as a company and figure out what amount of interest we can afford to pay and what are similar bonds paying at this period of time in interest. And then we're going to go through the bond indenture process, which could be several months, and we're going to issue it at a different date than when we determine and set that stated interest rate. That's something to keep in mind when we get down below. For the second or the last thing that's going to be listed on the bond certificate is the semi-annual interest payment dates. So when are these bonds going to pay interest to those bondholders? Most bonds pay out interest twice per year. Some of the examples that you have in practice problems or in your homework may pay interest once per year, and that would change some of your calculations that you're using. But for our examples and for most bonds, they do pay out interest 2 times per year. The nice thing about bonds is the bondholders know how much interest they'll receive and when they will receive interest. So that's why a lot of people, when they're investing later in life, they move most of their money from the stock market, which is more volatile, to bonds, because you're giving yourself a guaranteed amount that you're going to receive at set periods of time. It's much more stable. For bonds are going to be issued at any date, and they're traded in an open market usually. And these bonds are influenced by 2 interest rates. So we're looking at the relationship of the market interest rate, what similar bonds are offering, what similar bonds are paying in interest at the date that we issue these bonds, versus how much we're offering to pay in interest annually. So the relationship of these 2 interest rates are going to influence the issue price and how much we issue these bonds for. The issue price is important to know because the issue price is how much cash we're receiving when we issue the bonds. And it's based on this relationship here between the stated interest rate and the market interest rate. So we're going to look at an example, and I'm just going to make up numbers. And I want everybody to unmute themselves. because you're going to respond to me. I see nobody unmuting yourself. Okay, few. Okay, my bonds are offering you 5% interest annually. Similar bonds in the marketplace are offering 5% as well. So you can earn 5% interest on my bonds, or you can purchase similar bonds and you'll earn 5%. Is there any incentive to buy my bonds?
No.
No. Are my bonds essentially the same as other bonds?
Yeah.
In terms of revenue that's coming in for you? Yes. So when the stated interest rate equals the market interest rate, and this is extremely rare because the market interest rate is constantly fluctuating, even a small percentage. When the stated interest rate equals the market interest rate, we're going to issue these bonds at par value. So the issue price as a percentage of par right here is going to be 100% or 100. That's what it would say. And I'll just put down here that that's a percentage, meaning that we're going to issue these bonds at face value. We don't have to discount the bonds. We don't have to make a premium on these bonds. These are going to be issued at par value. So let's say that I issued $1,000 just to be easy. To figure out the bond issue price, if you're given the issue price as a percentage of par, we're going to multiply the issue price, which is 100%. Sorry, the issue price is a percentage of par, which is 100%, times the face value, the bonds issued, which was 1,000, to calculate the bond issue price, which is going to be $1,000. The bonds are issued at par value, face value.
Professor Wade, you were bringing up pretty bad.
Oh, sorry, it didn't tell me. Sorry, guys. Is this better?
Yeah.
I'm going to pause really fast. Just give me a second. I'm going to tell my family to stop streaming things. Okay. Better? So to calculate the bond issue price, when you're given the percentage of par value, you're going to take the issue price as a percentage of par times the face value or par value to back into your bond issue price. We're offering exactly the same interest as similar bonds are offering. So there's not going to be any effect to our issue price. We're going to issue these bonds at face value and receive cash for exactly what we have to pay back in the future. And this next part here, the impact on the carrying value as the bonds mature. There is no change. The carrying value of the bonds remains at face value. And what amount does the issuer pay back at maturity? Face value, so $1,000. I know that bonds can be pretty confusing, especially because most of you, these terms are new, actually probably 99% of you, and this is not something you deal with on a daily basis. So if you have questions, you're probably not the only one, and ask them. Does this make sense for par value? So issuing bonds at par, does that make sense? Okay. Do
Why
you need
doesn't
another?
the issuer pay back 1,000 plus 5% of that?
Okay, so sorry, and this is, I meant only the principal. So I meant not including interest. Does that make more sense?
Yeah.
Sorry about that. Okay. Is everybody kind of caught up on this part?
Yeah.
Okay. So we're going to go to the more likely scenario. And let's say that I'm offering a stated interest rate of 4% when the market is still offering 5%. So I set my stated interest rate when I determined that I want to go out for bonds, and the bond interest rate has increased from when I established my stated interest rate to when I issue my bonds. I'm offering 4% interest. The market's offering 5% interest. Who wants my bonds? Anybody?
Yeah. People want it because it's discounted, right?
Right now, is there any incentive? If there was no discount, if there's nothing like that,
Mm-hmm.
who wants my bonds?
Who doesn't?
Most people are not going to want my bonds. Most people are going to buy other people's bonds because they're offering a higher interest rate. If similar bonds are offering 5% and I'm only offering 4%, I'm offering less interest over the life of these bonds. And this is 4% per year. These bonds are 50-year term. That's a lot of interest. That's a whole interest rate that I'm giving up if I'm going to invest in your bonds versus, or my bonds versus somebody else's bonds. How can I incentivize people to buy my bonds if I'm offering less interest over time?
The discount, right?
Yeah, you lower the price, right? You have to lower the price to make it lucrative for them. If you pay me less up front, you're going to still receive the full amount later. So we discount those bonds, and it's going to be stated as an interest rate or a percentage below 100. So it could be 94, 95, something like that. And it's based on the present value of those future payments and how different these interest rates are. You don't have to worry about this. That's a finance kind of class, but it will be stated below 100, below 100%. So let's say that these bonds were issued for 97% of par value.
So is that 97% relative to, like, what does that number come from, or is it just a number?
That number is relative to the present value calculation that we were going to talk about.
Okay.
So basically, you're looking at the relationship and the difference between the 4% and the 5%, the market interest rate and the stated interest rate, and calculating out the present value of those future payments and backing into what that value is today in today's terms.
Okay.
Yeah. We get more into that in more managerial accounting. but basically it's discounting those future values back to the present day. So if my face value of the bonds is $1,000 and I issue those bonds at 97 or 97% of par, the issue price is going to be lower than face value, right? I'm going to receive $970. I had to discount my bonds and offer a lower issue price because I'm offering less interest over the life of these bonds. So when those bonds are issued at a discount, our issue price will always be less than or below par value. We discounted the bonds $30, the difference between face value and the issue price.
I'm kind of confused. Why? So if your interest rate is 4% versus 5%, isn't that better
For us,
for the buyer because they're gonna have to pay less in interest and less?
the purchaser of the bonds is earning less interest.
Sorry, you cut out.
Okay. The purchaser of the bonds is earning less interest over the life of the bonds. So in order for the purchaser to want to buy my bonds, I'm going to offer them a lower issue price. They have to pay.
Wade, you are cutting out pretty badly.
Okay, give me a second. I'm going to just stop this really fast. Okay. We're offering 4% interest. So I'm going to pay out to the bondholders 4% interest each year. If they went with a similar bond from a different company, they would actually be earning 5% interest. To the issuing company, we like.
Oh, okay. I was thinking a bond loan.
No. So it's a loan for the issuing company, but for the person that buys the bonds or invests in the bonds, it's their revenue stream.
Okay, I was looking at it like a credit card. Like,
Got it.
we're giving you money, and then here's your interest rate, but you want lower. So I was like, wait, why would you want higher interest rate? Like, that doesn't really make sense. But it's really just an incentive to purchase your bond. They're saying if you let us sell you this bond, we'll actually give you. It's almost like a discount, and right?
Correct. Yeah.
Okay.
So us as the issuing company, you're thinking of it correctly from the person having the debt. The issuing company is holding the debt. They want to pay less interest over time, right?
Mm-hmm.
So this is a good thing. That's why most bonds are issued at a discount, because companies want to pay less interest over time. The bad thing for the issuing company is that they're going to take a little bit less than face value. They're going to receive a little bit less than face value at the start of it. So we have to do that, because if we didn't discount it, then people wouldn't invest in our bonds.
Okay.
Now, the impact on the carrying value as bonds mature. So as we're reaching towards maturity, we have a discounted bond. We received less cash, so our carrying value initially is the 970, but at maturity, we're going to have to pay back face value regardless. So the impact that it has on the carrying value is that it's slowly going to be increasing toward face value. because at maturity, we're going to have to pay back face value on those bonds, $1,000. But that could be 5, 10, 15 years out, which is why we're discounting those cash flows to back into that 970. The further out that principal payment is, the better off we are. Does this make more sense? For the opposite side of it, let's say that I'm offering 7% interest when the market and similar bonds are offering 5%. Now who wants my bonds? I'm offering you 7% interest when similar bonds are offering you 5%. Who wants my
Everyone.
bonds? Everyone, right? We're offering a higher interest rate than similar bonds, so everybody wants my bonds. Think about supply and demand. Everybody wants my bonds, right? Demand's high, supply is low. What happens to the price? Shoots up. So the issue price as a percentage of par is going to be higher than 100. So let's say it's 109% of par. Face value on those bonds is still 1,000. But since these bonds were offering a substantially higher amount of interest, 2% higher, how much is the issuing company going to receive? What's the bond issue price?
1,090.
1,090. So they offer those bonds at a premium. That premium was $90, the difference between face value and then the issue price. The bond issue price when bonds are issued at a premium will always be above par value. So it's the opposite of a bond issued at a discount. What's going to happen to the bond carrying value over time? We're issuing it above par value, right? So over time, we're going to have to slowly reduce it. And it's going to decrease towards face value. And the reason being is because at maturity, the issuing company is going to pay back exactly face value, those bonds, $1,000. Right here is the reason why we only record face value or par value in the bonds payable account, because that's how much we're going to have to pay back at maturity for all bonds, regardless if they're issued at a premium, at par, or at a discount.
So if you invest $1,090, you're only going to get back $1,000.
Correct. But you're going to earn a lot more interest over the life of those bonds than any of the other bonds that were currently being offered. And that's why you're willing to pay a little bit more for those bonds.
So when you're paying a bond, so the advantage of paying a bond is that you're getting the interest, not the initial payment.
Yeah.
Okay.
Because essentially what you're receiving back is your initial investment in the company. It's the amount of interest that you're earning consistently on set dates for a set amount. So it's a very stable and easy way to estimate future cash flows for a company. Future cash flows for retirees.
So you get $1,000 back less whatever the interest rate is?
Yeah. With all of them, you're always going to get the face value plus the interest rate. And what you receive at maturity is the final interest payment. You've been receiving interest throughout the life of the bonds on those set dates. Okay. Do you guys want to take about 5 minutes or 10 minutes before we jump in? Yes?
Let's do it.
Okay. Okay, come back by, let's say, just 11 o'clock. Is that okay?
Sounds good.